All right, good evening, everyone, or good afternoon, or good morning, or whatever time that you are choosing to watch this video. I hope that you guys are all doing okay, that you are making it through and living your life as best you can. Past 48 hours have been really kind of tough for me, so if I sound extra angry or more salty than usual during this recording, that's why. I'm recording this as of 9:40 p.m. on March 24th, down here at the bottom for you guys to see. So here's kind of the latest information I have from UNCC and about COVID-19. If you guys are watching this video at a much later date, things might be different. Obviously, the situation is still rapidly evolving. There is a confirmed case of COVID-19 at UNCC. The person, I'm told, was studying abroad, but self-isolated after getting back, and so you were not exposed to coronavirus. So if you're feeling ill or anything else, I promise you that you did not catch coronavirus from this person. Um, the other thing is that the Housing and Residence Life is currently establishing a plan for students to be able to return to residence halls and complete checkout for spring semester. Dates and times for this are going to be shared a little bit later. You guys are asked to not return to residence halls just kind of unannounced. You have to wait for the Housing and Residence Life to tell you it's okay to come back and finish that kind of checkout process. Big thing is that today on March 24th, Mecklenburg County issued a stay-at-home order that's going to go into effect 8 a.m. on Thursday, on March 26th. There's still a lot that I don't really understand about the order. You're pretty much asked to just kind of like shelter in place, to not go outside unless, or to not really go anywhere unless you absolutely have to, like things go to the grocery store. If you're going to the doctor, you can go do that. I know that you can be outside to like exercise and walk your dogs if you have animals and kind of other things like that. But if your job is considered not essential, you're being asked not to report to work. That's kind of all the information I have about it right now. I have not had the time, unfortunately, to read through the entire proclamation, but there is information about it on Twitter. So if you go to Twitter and follow Mecklenburg County, you can see all of their tweets. And I'm sure that they'll be able to provide you a better explanation than I can. So today what we're going to do is we're going to talk about investing. And there is an investing quiz that is going to be due on Sunday by 11 p.m. By the time that you guys are watching this video, by the time you guys watch this video, I should have edited that quiz and made it available for you guys to take. Another quick thing is that if I sound different, I'm actually dog sitting for my parents right now. They are in the middle of trying to move, and they have two little dogs here at their house that I'm currently watching for the next few days. So if I sound really echoey, I apologize. I've tried to adjust my microphone to account for that. Or if you hear me yelling at dogs kind of in the background, that's what it is. Yikes. All right, so today we're going to talk about stocks, bonds, and mutual funds, otherwise known as investing. So as we already kind of talked about, banks are a really great place to store your money, but banks generally offer very little opportunities for growth. And when we talk about growth, we're talking about free money, money that you don't have to work for. The best way to make free money and make your money grow is to invest in something. And when we talk about investments, we're talking about committing money to some type of endeavor. It's a business, a project, real estate, with the expectation of obtaining additional income or profit. So you can invest in anything. You can invest in your own capital by going to school. You guys are investing money into your future. You're expecting to get out of school and have get a nice paying job so you can kind of pay back your student debt. That's an example of an investment. The main types of investments that we'll talk about here are stocks and mutual funds. We've already talked a little bit about bonds, so I don't want to go too much into it, but I do want to give you guys just kind of a nice refresher. So the first step when you're going to invest in something is you need to determine what your goals are, and your goals should be sort of measurable and specific. Like I have here some questions. How much money do you need to satisfy your investment goals? So maybe you kind of have this goal of, oh, well, within the next 6 years, I want to be able to pay off my student debt, or I want to be able to buy a house, or I want to get a car, or I want to move into an apartment all by myself. You have to think about how long it's going to take you to earn or obtain that money. Different investment opportunities with stocks and bonds obviously are going to offer different returns. So you need to look at that. You also need to look at how much risk that you're willing to take when you invest in something. Every investment is going to involve some degree of risk. Even like, for example, you guys being in school, you're investing in your future, but there's some type of risk with that. Your risk is that you may not be able to get a job once you graduate. Any type of investment, like the stock market, for example, is a great the stock market is a great example right now. The stock market is one of the surest ways to make money, but the stock market could crash at any time. Like I think the past kind of week, maybe 2 weeks, has been really, really horrible for people in the stock market. It's been so volatile, and people have lost a lot of money. You also need to think about making sacrifice. Like, are you willing to make the sacrifices necessary to reach your investment goals? You want to consider economic circumstances. Are your investment goals reasonable? Kind of, et cetera, et cetera. So generally, people break down their investment goals into 3 separate categories. Kind of like with the SMART goals that we've already talked about, you have your short-term, intermediate, and long-term goals. Generally, short-term goals with investments, that's going to be things like buying a car. I don't know, buying a car is probably the best thing that I can think of. Or like getting enough money to maybe pay off some type of like medical bill. That's an example of a short-term goal. Intermediate, kind of 1 to 5 years, is like paying off debt, and long-term is going to be like buying a house. So you guys generally when you buy a house, you need about 20% down. So if you're looking to maybe start putting money away to like buy a house at some point, it's probably going to be more of a long-term goal because you're going to be putting only small amounts of money away every month, or however often you put money away towards buying a house. So the 2 most common types of investments are bonds and stocks. We've already talked a little bit about bonds, so I don't want to go too much into it. But you guys know that bonds are essentially like a loan that you give a bank or a company, and then you collect it after a certain number of years plus interest. So you give the bank $100 now, and in 1 year you collect $200. 5 years you collect $500. 10 years you collect $1,000. The good thing about bonds is that bonds are actually very, very secure. I'd say like 99.99% of the time, your bond, whenever you buy it, is going to have is never really going to fail. The only time I can think of is when a U.S. government wouldn't honor a bond is like if the bond came from a foreign government. And just kind of thinking off the top of my head here, again, it's almost 10 o'clock at night and I'm exhausted. Things like with the Confederate States of America. During the American Civil War, people bought bonds from the federal Confederate government. And the American federal government would not honor those Confederate bonds because they never recognized that government. So people lost that money, so their bonds weren't really worth anything. But because we're not in the middle of a civil war right now, buying bonds from something like the federal government, you're pretty much going to be guaranteed some type of return. You're going to have a lot of growth. You're going to have a lot of security. The most common type of bond is a certificate of deposit, which we've already talked about. You guys know that a CD has a fixed term. It's 1 to 6 months, 1 to 5 years. You hold it until maturity, at which time you get to withdraw your principal and any accrued interest. Again, certificates of deposits are going to be very, very stable. I mean, your money is going to be guaranteed to go up. It is guaranteed to start accruing interest. You may have to pay penalties if you withdraw early or if you cash in a bond or a certificate of deposit early, but I don't know. I mean, again, even if you do have to pay that penalty, you're still guaranteed to make money. You're gonna, like for example, up here, you're gonna put $10,000 in, and after 5 years, you're gonna get $12,000 out. That's $2,167 that you guys didn't have to work for. That was money that you got just sitting at home on your year end, doing nothing but looking pretty. So stocks, on the other hand, stocks are they offer less security, but there's more opportunity for growth. So when we talk about stocks, there are different kinds of stocks. There's common stock and preferred stock. I don't really want to go into it in this lecture because I'm trying to sort of make them a little bit shorter because I know the very first one I made was like 40 minutes long, and I noticed that a lot of you guys didn't watch that video, so I'm trying to make this a little bit shorter. So if you want to know the difference between common stock and preferred stock, you can go into your textbook. Your textbook offers a really great section about that. And the page numbers for that are on Canvas under the calendar. But stocks give you partial ownership of a company, and over time, the value of that share goes up and you earn money. So, for example, let's say you bought stock in Apple or you bought stock in Apple in December in 2010. For that one share, that one stock in Apple, you would have paid $41. And now, about 10 years later, let's say you're ready to cash that stock in, you're going to get $246. So that's pretty much $200 for free that you did not have to work for. You got that just, at home, sitting on your end, doing nothing but looking pretty. So the stock market is one of the surest ways to make money. Even in a situation right now, like the stock market is very, very volatile. It's been crashing. It's been going up and down. Like I know that today, March 24th, was one of the highest growth days ever for the Dow Jones Industrial, which we'll talk about in just a couple of slides. But I mean, also in the past 2 weeks has been really, really awful for the stock market. I mean, we dropped from about the Dow Jones was around 30,000 points before the coronavirus hit, and it went down to like 18,000. And there's no telling what the stock market is going to do tomorrow. But if you're in it for the long haul, stocks are investing in the stock market is one of the greatest ways that you can make money. And there's a way that you can do it through mutual funds that I'll talk about in just a moment. So you guys can think of a stock kind of like this. So let's say that you have your circle here, and each of these little triangles kind of in between them represent shares of a company. I know that all the triangles are unequal. I apologize for that when I made this, but just pretend that they're all equal for argument's sake. So here's what you do. Let's say that you're the owner of a business and you want to go ahead and sell money, or you want to go ahead and sell stocks of your company, sell some ownership. So what you do, because you want to make sure that at least 51% of the business always belongs to you, is when you're creating stocks, you kind of draw a line down the middle. And I'm not doing a very good job of that, I realize. Maybe this might work a little bit better. Yeah. All right. So, and you say, all right, well, I'm going to keep all of this stock. Let's use a different color. You're going to say, I'm going to keep all of this stock right over here for me. This is all my stock. This is how I'm going to make my money. This is how I retain ownership of my company. So you get 50%, and let's just say, for argument's sake, that you want to be really, really safe about it, and you want 51%. So you buy 51% of the company that you already own in your stocks, and this is kind of how you retain control. Because when you're operating in the stock market and you have partial ownership of a company, when you buy that company's stock, you do actually get voting rights in that company because you own a little bit of it. But what CEOs do, like with Apple, for example, is that the CEO will still have 51% of its stock. But the rest of these, they'll go ahead and sell out. So somebody will come along and they will buy this share right here, kind of coloring on the outside here so you guys can see it. Someone else is going to come along and they're going to buy this share. Someone's going to come along and they're going to buy this share. And so forth, and so forth, and so forth. Someone will eventually buy all of these shares. So when you own, like let's say, for example, this share kind of right here, you own a little bit of the company of whatever it is that this represents, like let's say it's Apple or it's Google or something like that. So you can vote on certain rights or where you want the company to go in the future. Like if Google or Apple's going to make a big decision and you're a stockholder, you kind of get a say because you own a little bit of it. You own a little bit of the company. And you, again, all right, so let's say, for example, that when you first bought this stock, you first bought the share of Apple, it was only $40, and now you're ready to sell this share back, and it's now worth $200. So you lose your share of the stock, but you get back a bunch of money in return, if that kind of makes sense. So stocks are traded and sold via stock exchanges like the New York Stock Exchange. The New York Stock Exchange is one of the biggest places, or one of the most, I guess, famous places where you can go and buy stocks. When stock prices are generally rising, it's called a bull market. I don't know the symbolism behind that. I don't know the history behind that. But it's generally called a bull market. So if you go to New York City and you go to the New York Stock Exchange, you'll notice that there's like a bull outside the exchange. That's the idea of that, it's just kind of a symbol of the stock market always rising. So generally, if you're investing in the stock market, you always want stock prices to rise. You always want stock prices to rise because when you buy that one little share of Apple for $40, you want to be able to sell it for like $200. When stock prices are for the most part decreasing, it's called a bear market. I'd say in the most recent past, I'd say pretty much, I'd say since our President Obama entered into his second term, we've really been in a bull market. Stock prices have generally been increasing. Right now, I wouldn't quite say that we're in a bear market, just because again the stock market is way too volatile right now. There's still a lot of unknowns with the whole pandemic. We've never really experienced something like this, at least not in over 100 years. So yeah, I wouldn't say we're in a bear market just yet, but historically we have been in a bull market. So companies trade their stock, or companies that trade their stock. Companies that trade on the stock exchange have a little ticker symbol that identifies who they are. So, for example, Microsoft is MSFT, Southwest Airlines is LUV, Apple is AAPL, Google is GOOG. So, if you guys are if you go and you watch stock tickers at a New York Stock Exchange, you'll see Microsoft, MSFT, up let's say $2, something like that. So a stock market index like the Dow Jones or the S&P 500 are a collection of stocks that's representative of the stock market as a whole. Let's see. All right. So I'm sorry. I just had a thought and it just totally went out of my mind. All right. So looking at the Dow Jones or the S&P 500, it's kind of like taking the temperature of our economy. It's a way to sort of measure how healthy the stock market is and how healthy our economy is. So the Dow Jones represents 30 most significant stocks in the stock market, and that's generally things like Apple, Disney, Coca-Cola. Stocks that are going to pretty much do very, very well are going to be very, very stable. And like I put down there, it gives a general idea of how healthy the stock market is. When the Dow Jones Industrial is way, way up, when it's at 30,000 points, that's a really good sign that the stock market is doing excellent and that we're in a bull market, for example. Versus when the Dow Jones Industrial drops way, way low, to 18,000 points, people say oh my God, we're in a bear market, the stock market's crashing, blah, 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 blah. I think we kind of talked about it a little bit in class already. When people say the Dow Jones Industrial fell, 2,000 points today, it's just kind of a sign that the stock market isn't doing as well as it could be. So here's kind of what the Dow Jones Industrial Average has looked like since just about before 1900. Right here is the Great Depression, the stock market crash of 1929 that happened just under 100 years ago. Excuse me. This is the Dow Jones Industrial Average. You can see that it fell a really long way, and it kind of took it a couple years for it to really recover and get back to where it was. Here, for example, is the 2008. Yeah, you guys should all remember 2008. 2008 was one of the most significant stock market crashes of all time. If you want to learn more about it, your book might talk about it. I don't really know. You can also just Google it. 2008 was a really, really huge hit to the housing market, and the Dow Jones Industrial fell really, really far. It hit a high of 14,000, and it dropped to below 7,000, or right around 5,000 points, I think. So that was a really, really big hit for it. I don't have a graph that shows what the Dow Jones Industrial Average looks like currently, because again, we started out at 30,000 points and we dropped down to 14,000 points. So that's obviously not good. When the Dow Jones Industrial goes south, it's generally a sign that the stock market is not in a good place. The key to stocks is just to buy low, sell high. I kind of have that phrase in there: buy low, sell high, get money, word. The idea is that, when stocks are very, very low and the stock market has crashed, like for example right now, now is the time to go out and buy stocks. And the stock market is like way, way up, and the Dow Jones Industrial is like at 30,000 points. That might be a really good time to sell your stock and get a bunch of free money. So the two kind of stocks that I want to mention very quickly are blue chip stocks and penny stocks. Blue chip stocks are older, more established companies with very stable stocks. They're almost guaranteed to go up in price. So if you guys are interested in buying stocks, which I recommend that you guys do, I recommend that everyone gets invested in the stock market because it's a very easy way to make money. You might want to consider buying. Excuse me, I don't know what's gotten into me tonight. You might want to consider buying some blue chip stocks because like the chances of Disney going out of business tomorrow or Apple going out of business tomorrow are very, very low. Even like right now, for example, the stock market is very, very volatile because of coronavirus. Apple is not going to go out of business. You're not going to lose all your money. I mean, you might lose some money, but over time you'll gain it back. Penny stocks, on the other hand, are companies that are just starting out. They offer the most reward at the greatest risk. Because if you were to go and invest in a penny stock, I mean, sometimes you can buy them literally for a penny. And in like 5-10 years, that company takes off and that same stock is now worth like, I don't know, $1,000. I mean, that's a huge rate of return that you can get. So blue chip stocks are going to offer you a more secure return, but it's going to not be as high of a return. Penny stocks, on the other hand, are going to be a little bit more of a game of luck, but they offer you the most reward. So the stock market in general is actually pretty confusing, and there are a lot of rules on when and how you can buy stocks and things like insider trading. Most people, unless you're like really interested in going into stocks and going into economics, aren't really going to know how stocks work. Like you can't really just march into the New York Stock Exchange and start buying stocks. You generally have to go through a stockbroker. One of the easiest ways that you can get involved in a stock market or in the stock market is through mutual funds. Mutual funds, to me, are one of the easiest and greatest things that have ever been invented. I mean, if you guys do nothing else with trying to invest money, please invest in a mutual fund. Mutual funds, the way it works is that you get a bunch of investors together, you and just other complete strangers, and you give your money to a fund manager, and the fund manager is going to select kind of what kind of stocks to put your money in. So maybe if the stock market is like, crashing, your fund manager might put all your money into very, very stable stocks. Things like, Apple and Disney. Versus if the stock market is, way, way up and the economy is great and everything else, your fund manager might be a little bit more risky and like, take some chances with your money for a little bit. And as kind of those securities go up, as you get a greater amount of return, as your money goes up, that extra money comes back to you, and your fund manager just takes a little bit of a cut. So I know that it sounds a little bit sketchy giving somebody all of your money and telling them to go buy stocks with it, but mutual funds are the simplest way to enter into the stock market for the average person. Typically, with most companies, you can tell them how risky you want them to be with your money. You can have like a high risk, high reward situation, invest in a bunch of penny stocks. You can do like a moderate risk, moderate reward, a lower risk, low reward. It is a little bit of a gamble, obviously, but if you're in it for the long term, you're always going to make money on the stock market. And different types of mutual funds are going to have those different risks. So when you guys are ready to invest in some type of mutual fund, you can talk to a fund manager and ask them about the different funds that they offer. And you can also kind of spread your money throughout. Maybe you can put a little bit of money in a high risk. You can put a little bit of money in a moderate risk, a little bit of money in a low risk. And you can also move that around. So you guys are generally very, very young. So you might want to start out with like a high risk, high reward scenario. And then once you get a little bit older into your 40s and 50s, maybe drop it down to a moderate risk or even to a low risk and focus like more on asset preservation, I'd say, than asset growth. So mutual fund companies can help you manage your financial portfolio. Your financial portfolio, when when we talk about that, that's like kind of what assets you have, like bank accounts, stocks, real estate, etc., etc. And they can also give you advice on how to move forward. So the person that does this is going to be called your financial planner. And financial planners are going to be offered at pretty much any type of financial institution that's out there. I have some examples down here like T. Rowe Price, Goldman Sachs, Wells Fargo, Ameriprise, Morgan Stanley. These companies all have mutual funds and you can just walk in there and talk to a financial planner, and you can get it set up with a mutual fund. Personally, I use T. Rowe Price. I did everything with T. Rowe Price online. I did my own research. I invested in a mutual fund called Capital Appreciation, which is moderate risk, moderate reward. It was pretty easy for me to get set up with it, so I'd recommend T. Rowe Price. My parents, they have mutual funds through Ameriprise. They've said that they've really liked it. My aunt had mutual funds through Morgan Stanley, so I've worked with them for a little bit. They've been really good. I recommend that you guys just kind of pick a company. You just kind of throw a dart at the wall, talk to a financial planner, ask them about mutual funds, what you think that you should invest in. And once you do, you can invest your money and literally just watch it grow. If I didn't have to upload this to YouTube, I would literally just show you guys what T. Rowe Price website looks like. But I really don't want to blast my finances all over YouTube. So whatever, doesn't matter. All right, so that's it for this lecture. We're done. Big thing to remember is just that there's an investing quiz due for you guys by 11 p.m. By the time that I upload this, that investing quiz should be up, so you guys can go ahead and take that. Please do not come to resident halls unannounced. Please know that there is a confirmed case of COVID-19 at UNCC, but you were not exposed to that person because they were in self-isolation. And please be aware of the stay-at-home order for Mecklenburg County, which begins this Thursday on March 26th. So I have done here actually the wrong timestamp. It is actually, as I'm recording this, it is 10:04, not 8:18. I guess I should say PM. All right, but thank you guys for listening. Sorry if I rambled today. Sorry if I seemed really tired or stumbled through my words a little bit. The last 48 hours, like I said, have been super stressful. I'm sure it's been super stressful for you guys as well. So thank you for sticking with me. We'll get through this just kind of one day at a time. If you guys have any questions, comments, concerns, again, please feel free to email me, send me messages on Canvas, and I will answer your questions to the best of my ability. Thanks, guys.